Welcome again to our accounting classroom, and today we are going to be looking at the topic of takeovers. Now, with reference to takeovers, you can have a business can be taken over by another business, and then when this happens, generally the taken over business will no longer trade as a separate entity. So if company A takes over company B, then company B will no longer trade as a separate entity. As a matter of fact, it ceases to exist, and then you will only have company A. Now, you can have a company taking over a partnership to make it into a company, but then you can also have companies taking over other companies. But what we are going to look at today in our example video is a company taking over another company. Now, when this happens, the company pays under what is called the purchase consideration. Now, the company taking over, if company A is taking over company B, then company A can opt to pay for the business in cash, or by issuing shares at par or premium, or possibly by having loan notes, or a combination of cash, shares, and loan notes. And this is known as the purchase consideration. So again, if company A decides to take over company B, then company A can opt to pay company B in cash, or by issuing shares, or by loan notes, or a possibility of a combination of all three of those things, and that will be known as a purchase consideration. Now, when a company takes over another company, you can have either a partial takeover where let's say company B sells its shares to company A, and you will recognize that an investment in B exists by company A. So company A will have an investment in company B, but company B will still exist, right? So you have that is a partial takeover where a company can be just buy the shares, where one company sells its shares to the other company. Then you have a complete takeover. A complete takeover is when one company takes over all the assets and liabilities of the other company. So let's say using the company A and B again, company B sells all its assets and its liabilities to company A. So when that happens, then company B will cease to exist, and then you only have company A. So what we are going to look at is how we record all of these transactions when we have a complete takeover and then when we have a partial takeover. So when we have a complete takeover, the first thing that has to be done is that the net assets of company B must be closed off to what is called the realization account, and we would have encountered the realization account when we did the solutions earlier on in another video. So after we've transferred the net assets of company B to the realization account, then we will transfer the capital section of the capital section of company B to what is called now a sundry shareholders account. Now, the capital section will comprise of the ordinary shares, preference shares, share premium, profit and loss or retained earnings, the reserves, generally whatever reserves there are. So those are closed off to the sundry shareholders account, and all of that is what the investors would have inside of company B. So that is closed off to the sundry shareholders. Then what happens then is that company B will no longer exist, and goodwill of the sale must be established for company A. So to establish the goodwill for company A, the formula is to take the purchase consideration and subtract the value of the net assets of company B. So you will subtract the value of the net assets of company B from the purchase consideration, and you will then get your goodwill. Or in some cases, it might be negative goodwill. Then, after we have done all of that, we will then take the assets of company A and the value of the net assets that were taken over by company from company B, and we will combine those assets together, those net assets together, in the statement of financial position for company A. Now, all of this will be shown to you today because we're going to use an example question here from a past paper of 2010 called Insure Limited. So this is question 3 on that past paper. It's called Insure Limited, and we're going to use this question as an example today. So I'm going to read this question for you. When you're going through the video, what you can do, you can pause, you can look at the question, and you can go back and forth. So it says Insure Limited, a retailing company, had the following balances on its book: land and building, 66,000, plant and machinery, 44,000, debtors, 94,000, creditors, 80,000, ordinary share capital, 110,000, preference share capital, 60,000, vehicles, 25,000, and stock, 40,000, bank, 50,000, general reserve, 12,000, retained profits, negative 13,000, and 5% debentures, 70,000. Now remember that our debtors are also known as accounts receivable, our creditors are known as accounts payable, our inventory is known as, our stock is also known as inventory, and our debentures are also known as loan notes. Continuing, it says the par value of insurer's ordinary shares is $2 per share, which means that the value of these ordinary shares, this $110,000 in ordinary share, it has a par value of $2 per share. Insure Limited decided to take over another company, Wall Limited, which had the following assets and liability. So Insure is going to take over Wall Limited, and these are the assets and liability for Wall Limited. Wall has bank of 4,000, plant and machinery 19,000, vehicles 5,000, stock 22,000, debtors 17,000, profit and loss or retained earnings $2,000, debentures 6%, debentures 8,000, ordinary share capital 50,000, general reserve of $1,000, and creditors of $6,000. Now all the net assets were taken over at the new agreed values as shown below. So we have all of Wall's net assets, which will be their assets minus their liabilities, were taken over, because that's how we get the net assets. Assets minus liabilities will give us net assets. So all of Wall's net assets were taken over at these agreed values. So a bank is the same $4,000, plant and machinery $19,300, debtors $16,400, creditors $5,850, vehicles $4,500, stock $18,500, and debentures $8,000. The question goes on to say a loss on realization of $3,500 was computed by Wall's Limited's accountant, with Insure Limited giving ordinary shares at a premium of 20 cents to the shareholder in settlement of the purchase consideration. So that is what Insure Limited did. Insure Limited gave the shareholders in Wall's Limited, gave the shareholders in Wall's Limited shares, ordinary shares at a premium of 20 cents, which meaning that the par value, yes, is $2, and then there's an extra 20 cents that they were given the shares at. Then it goes on to say that that it was in settlement of the purchase consideration. Then Insure Limited also decided to exchange with the shareholders of Frank Limited. So Wall Limited is a complete takeover. So here now, Ensure Limited has also decided to exchange with shareholders of Frank Limited 2 shares in Ensure Limited at a premium of 30% for every 5 shares held in Frank Limited. So this is a partial takeover, which means then that Ensure Limited is going to have an investment inside of Frank Limited. So Frank Limited's issue share capital consists of 20,000 shares of $1 each. So this question is asking us to prepare the realization. A, prepare the realization account in WALS Limited's books. B, prepare the sundry shareholders account for WAL Limited to reflect the closure of the business. C, compute the share premium value of the ordinary shares given to WAL Limited in settlement of the purchase consideration. And D, prepare the statement of financial position for Ensure Limited after the acquisition of both companies. So what we are going to start with first is we are going to look at the realization account. I have already started the realization account, and remember that we said that the first thing that we will do, and this is in the books of WAL Limited, the first thing that we will do is to close off the net assets of WALS Limited to the realization account. So WAL Limited had bank of $4,000, plant and machinery of $19,000, vehicles $5,000, stock $22,000, and the debtors of $17,000. So we are debiting these accounts, these asset accounts, debiting the realization account because the asset account itself will be credited in order to close that account from off the books of WALS Limited. Then we have creditors of $6,000, the debentures of $8,000. So what will happen here with these liabilities, the liability account of itself will be debited for the amount, which will close the liability account, and the realization account is credited with the same amount. So this takes care of the closure, closing the net assets from off the books of the business of WAL. Additionally, the question said that there was a loss on the realization. So WALS Limited had a loss on realization. So therefore, that loss is credited to the realization account. So you have a loss of $3,500 being credited to the realization account. And then what we did here is that we took the difference between the debit side of the realization account, and so we took the difference between the $67,000. We had $67,000 minus $6,000, $8,000, and $3,500, which give us then the $49,500 as the purchase consideration for Ensure Limited. So after we have completed the realization account, the sundry shareholder account is done in a similar fashion, where then we would work out, then we will close off the transfer. What we're going to do then is to transfer the capital section. That's what we have done here, is transfer the capital section of WALS Limited balance sheet to the sundry shareholders account. So we transfer the profit and loss of $2,000, the ordinary share capital of $50,000, and the general reserves of $1,000 to the sundry shareholders account. And all of these are in here because this is what belongs to the investors. Then we realized we had a loss on realization, so that is debited in the sundry shareholders account, and the purchase consideration is also debited in the sundry shareholders account. So then we would total both sides. So it's going to $53,000. $53,000 on both sides, so it balances out. So now after we have completed the requirement A, which is to prepare the realization account, and we have also prepared requirement B, which is to prepare the sundry shareholders account for WALS Limited. So now what we are going to do, the answers in C to compute the share premium value of ordinary shares given to WALS Limited in the settlement of the purchase consideration. So we're going to compute the share premium value. So we have to first calculate the number of shares. So the number of shares, we take the purchase consideration, which is the $49,500, and we are going to $49,500, and we are going to divide that by $2.20, because remember that the value, the purchase consideration is $49,000 because of the shares, but these shares were issued at a premium of 20 cents. So the par is $2, the premium is 20 cents. So therefore that's $2.20. So we're going to take the purchase consideration, which is the value, and divide it by the $2.20, which gives us a number of shares of 22,500 shares. So now we are going to calculate then the value of the share premium. So the value of the share premium, we will take the 22,500 shares, and we are going to multiply that by 20 cents. Okay. So we're calculating the value of the shares, the share premium. So we calculate the number of shares. That's the first thing we did, calculate the number of shares. Now we are going to calculate the value of the share premium. So the value of the share premium is the 22,500 shares multiplied by 20 cents, which is $4,500. So $4,500 is the value of our share premium. So that is C. They had asked us to calculate the value of the share premium. If we want to know the value of the ordinary shares with reference to this same that was given to WAL Limited, if we want to calculate the value, this is not a requirement, but if we want to know the value of ordinary shares, then it would be the 22,500 shares multiplied by $2. Okay, that's what that would be. So that is 22,500 multiplied by $2. So the value of the ordinary shares is $45,000. But again, the question only asked us to compute the value of the share premium. So in order to calculate the value of the share premium, we have to first calculate the number of shares. And when we get the number of shares, then we take that number of shares and multiply it by the premium, which is the 20 cents. So we get the value of the share premium of 4,500. But then our ordinary shares will be $45,000. Additionally, this was not a requirement, but it's something that we have to do because the question stated that Ensure Limited, if you go back here, the question said Ensure Limited also decided to exchange with shareholders of Frank Limited 2 shares in Ensure Limited at a premium of 30% for every 5 shares held in Frank Limited. So we have to work out what the investment that Ensure Limited has inside of Frank Limited. So that is the other thing that we want to work out. Now we want to calculate the investment. So investment in Frank Limited. Okay. So investment in Frank Limited. So first thing you have to do is to work out the number of shares. And to calculate the number of shares, it will be because Frank Limited has issue share capital of 20,000 shares of $1 each. So then it is $20,000, and that is going to be multiplied by 2 on 5. 2 divided by 5 to get the number of shares. So this equals to which is 8,000 shares. So the investment is going to be 8,000 shares. So then we have to find out now what is the nominal. We're going to work out the nominal value of the shares, which is what we did with Wall Limited when I calculated the value of the ordinary shares. So we're going to calculate now the nominal of the shares. And to calculate that, you would take the 8,000 shares and multiply by $2, because remember that the shares in Ensure Limited par value of shares is $2 per share. So then it's 8,000 multiplied by 2, which is $16,000. So that's the nominal value of the shares that they have in, the value of the ordinary shares that they have in Frank Limited. So we also need to, they didn't ask us for this, but we can also calculate the share premium, because if we wanted to calculate the share premium, then a matter of fact, what we need to calculate after we calculate the nominal value of share, we calculate the value of the investment. So the value of the investment instead of Frank Limited would be then the $16,000. That is going to be multiplied by 130%. Why that? Because they say that Ensure Limited decided to exchange. That's what they say here. Ensure Limited decided to exchange with the shareholders of Frank Limited 2 shares in Ensure at a premium of 30% for every 5 shares held in Frank Limited. Okay, so that is like 130%. Yeah, so this is equals $16,000 multiplied by 130, sorry, 1.3, which is the same thing as 130%. So the value that they have, the investment, the value of the investment that Ensure has in Frank Limited is $20,800. The next thing that we want to calculate is our goodwill. So you want to calculate goodwill. So to calculate goodwill for Ensure, you would take the net assets of the taken over value of the net assets of Wall, and you will subtract that figure from the purchase consideration, that which is the amount of money that the value of the shares that Insured had issued to the shareholders of Walls Limited, and the value of those shares was $49,500. And we are going to calculate the net assets of the taken over value of the net assets, and we're going to subtract one figure from the other. So to calculate the net assets, it would be $4,000 plus $19,300. Because the bank is $4,000, plan is $19,300 plus debtors of $16,400 plus plus vehicles of $4,500 plus stock of $18,500. So we are going to take these and we are going to add these together, and what we're subtracting from these here, remember your net assets is your assets minus your liabilities. So our liabilities then is our creditors of $58.50 plus our debentures of $8,000. So that is, I show you where I got my figures from. So then I'm going to actually do the calculation and show you how much that would be. So that is equals 4,000 plus 19,300 plus 16,400. Sorry about that. 19,000 plus 16,400 plus 4,500 plus 18,500 minus 58.50 plus 8,000. So our net assets, so this is our net assets. Net assets is $48,850. So then the actual goodwill then would be the purchase consideration of $49,500 minus the $48,850. So my goodwill then would be equals $49,500 minus $48,850. So my goodwill is $650. So we have done all our calculations, and some of them were not a part of the requirements, but you must understand when you read the question that we're looking at a complete takeover of Walls Limited. But not only that, we're also then looking at the partial takeover of Ensure Limited. So what we are going to do quickly is the statement of financial position for Ensure Limited, which is D. So then they asked us to do the statement of financial position of Ensure Limited after the acquisition. So Ensure Limited statement of financial position as at, we don't know the date. So we're going to start with our intangible assets, which is our goodwill that we just calculated of $650. Then we have our non-current assets. And non-current assets, we have land and buildings. And we have that Ensure have land and buildings of $66,000. So that is $66,000. Then we have plant and machinery. And what we are going to do, we are going to combine the plant and machinery for Ensure with the taken over value for Wall. So insured plant and machinery is $44,000, and the taken over value for our wall is $19,300. So we're going to combine those two figures together, which give us a total of $63,300 for plant and machinery. Then we have vehicle. We do the same thing for our vehicles. Insure have vehicle of $25,000. Well, wall taken over is $45,000. So we're going to combine the two of those together. So our total combination of our intangible and tangible assets, which is our current asset, will be equals $159,400. To that, we will add our investment in Frank Limited. And that investment, we calculated it earlier on that the investment is $20,800. So then we are going to add the two of those figures together, $159,450 plus the 20. So our total assets here, which is our intangible plus our non-current plus our investment, is $180,250. We are going to then look at our current assets. So our current assets are stock, which is $40,000 plus $18,500. Then we have our debtors, which are $94,000 plus $16,400. Then we have our bank, which is $50,000 plus our $4,000, which is $54,000. And then that gives us our total current assets of $22,900. So then our total assets would be this plus our current $403,500. We're going to take away our liabilities. So our liabilities, we have our creditors, which will be $80,000 from Insure plus the $5,850 from Wall, which give us so when we subtract that from our assets, we have $317,300. So we're going to look at our non-current assets, which should be our 5% debentures from Insure and our 6% debentures from Wall. Two of those added together is $78,000, and then we are going to subtract that from a $317,300, which give us net assets of a total of $239,000. So our net assets, $239,300. So net assets is $239,000. So then this is financed by our share capital, and our share capital is our ordinary shares, and our ordinary shares would be the $110,000 in shares from Insure, $16,000 that were in Wall, plus $16,000 in Frank, plus $45,000 for Wall. So that would be equals to and then we have our preference shares, of $60,000. So then we also financed by our reserves, and we have our share premium, and our share premium will be the $20,800, which was the investment, minus the $16,000, plus then the 45 that we calculated. So that equals 20,800 minus the 16,000 to get the premium for that, plus then the 4,500, which was the premium before. And then we have our general reserves, and our general reserves is $12,000. And then we have retained profits, and our retained profits is a negative $13,000. So we have here $8,300, and then we're going to add $2,300 plus our $8,300, which then gives us our share capital, and reserves. So here we have share capital and reserves for Insure Limited of $239,300. So that's it for our session on takeovers, and you can always pause, rewind, and go back and look at the video over and over.